What I'd like to cover here is reading momentum in its most basic form, and that's in the trading pit. What you're looking at here is a picture of the 30-year bond pit and a bunch of traders that are offering the market, and we can tell that because we can see their palms of their hands. When you're offering or trying to sell, you would have the palms of your hands facing inward in the pit. This was an incredible edge we had while on the trading floor, where we could tell who was controlling direction simply by whether we could see the palms of their hands or if we could see their knuckles. In this photo, we see a bunch of brokers trying to buy the market, or they're showing bids, and we can tell that by seeing their knuckles. Now that most trading is done electronically, this edge no longer exists, so we have to find a way to read momentum either on charts or by watching screens. One of the most popular and logical tools for tracking momentum are candlesticks. And simply, if a market closes above an open, you will keep the candlestick hollow, and that is a sign of bullish momentum. On the other hand, if you get a close below an open in a given time frame, you would shade that and it would be considered bearish. When I look at macrograph, I think I can be a little bit more precise in defining momentum simply by tracking where the high volume price is and the value areas for that matter. For instance, if a market closes within value or at the high volume prices, it would be considered neutral. However, if a market closes below the fair price, that means that sellers are in control and that lower prices are apt to follow, as you see right here. So just by tracking the high volume prices, we can get a pretty good read on who's controlling momentum. And there are degrees of tracking momentum. A close below fair value would be more negative than one closing within value. I believe momentum begins and ends at high volume prices. So when I look at macrographs, I search for these profiles that are well defined, far below average value areas, and maybe far above average time at price. These are the types of things you see before a market begins to trend. That's why we have these spreadsheets that accompany each chart. I could tell if a market is wound a little too tight. The difference in the value area is smaller than normal, and you see in the bottom you have the median values. You can tell by the time at price when a market's wound a bit too tight, making it ripe to run. These are great indicators for timing, and not just in day profiles, but these work for weeks, months, quarters, any time frame you like. And we'll talk more about timing in another video.